What's up, traders? So in today's video, I'm going to be talking about the safer way to trade earnings. So we have earnings seasons coming up, and a lot of people like trade earnings, but a lot of people, how they treat earnings is it's basically a gamble. Nowadays with stocks, they can announce good earnings, but bad guidance, and the stock will drop. Or they can announce that they beat earnings, but not enough, and the stock will drop. It happened with Triple M. So that wouldn't be the best way to beat plain earnings because it's just a gamble at that point, and you don't want to be treating stock trading like just gambling because that's uncertain and it can be very expensive. For example, we have Apple, Amazon, and Facebook announcing earnings this Thursday. And let's say you wanted to play earnings for Amazon, you were bullish on it, which I believe a lot of people are and a lot of people should be. But the thing is, if you were to buy a call for this July 31st, this Friday, all right, a $3,100 call, it would cost you $8,195 just to buy this call. That is very expensive and you would be risking a lot. Why? Because if Amazon does not go above $3,100, the implied volatility is almost 80% on this contract and it will get crushed. Have you heard of Ivy Crush? It's real and it will happen to you here. So if Amazon announces good earnings but something with guidance, any reason, and it goes down, the next day on Friday, this contract will get absolutely crushed. Or let's say Amazon does beat earnings, but they don't really break too far above $3,100. You can also lose money. It's such a bad way to trade it because you are risking too much money. You're risking $8,000. A lot of people don't even have $8,000 to be risking in the first place. So a much safer way you could be trading earnings is doing a call debit spread. And I'm going to show you how to set it up. So how you set up a debit spread is first you click sell. You're going to be selling this contract. Then you're going to click buy and you will be buying a contract underneath it. So what ends up happening is it will cost you $195. So that is your max risk. The max money that you can lose would only be $195. That's amazing. You're no longer risking the full $8,195. But what's the catch? The catch is that you have a max profit. So the max profit is always the difference in the strike prices. So $3,100 minus $3,095 is $5 times 100, because you're always talking about hundreds when you're trading options. That'd be $500, right? But you spent $195 to initially get into it. So your real max profit would only be $305. That would be your max profit if by Friday Amazon is above $3,100. It can be $3,100 and a penny. You will make max profit of $305, which is absolutely amazing. You can do the same thing with Apple. Let's say you have a very bullish ambition, a bullish outlook with Apple. Apple was sold off last week with the entire market. It sold off pretty heavily. If we can see here, look at that drastic dip. It was very sold off and now it's slowly recovering. And I can definitely see Apple trading at around $385 by the end of the week. And if they announce good earnings, they can definitely shoot up as well. If we look at Market Watch, we can see that Apple target price got a boost at the JP Morgan. So previously they had a prediction of $365 for Apple, but now it rose to $425. This is amazing for Apple because it's only adding to the company and to how good of a company it is and the projected price of the stock price that it can get in the future. So let's say you do want to play Apple and you're thinking, oh, it's going to go to $385 after earnings. So you can do the same exact thing. So let's say you don't have $635 just to buy this call, just a normal call, because you can't afford it. You don't have $635. What you can do is you can sell the call and then you can buy the call underneath it, and you are now in a call debit spread. Make sure it says call debit spread. So the max you will lose is only $113, but the max profit would be $385 minus $382, which is 2.5. 2.5 times 100 is $250. $250 minus 113, and that would be your max profit. That would be around $137, which is amazing because you're only risking $113. And Amazon definitely has a very good potential, It has a lot of potential to break above $385. I think we can all agree on that. It only would have to rise $7 after it beats earnings, right? If you have a bullish outlook. And if it doesn't, well, you're only risking $113 as opposed to risking $635. So that is one way you can play earnings. If you're wondering, well, do you even do this? Yes, I do. You can see that here for for Amazon, I opened up a new debit spread, call debit spread. I actually sold off my other ones because I was just gonna take small profits. It was a really small profit. It was like $10, but it's still profit. And then I opened up this new one because I had two, but I only want one. I don't want to be risking that much money. So then here is my call debit spread. It's a 3,155, 3,160 call debit spread. We can see here I sold the $3,160 call, and then I bought the $3,155 call. And then this means that the difference here, this means that it cost me $160. So if Amazon closes above 3,160, I will make 500, the difference in the strike price, minus 160. So it would be 340. So $340 is my max profit on this, and I'm only risking $160 at max. So that is a risk reward ratio of 2-to-1. That is a way better play to make as opposed to just risking $6,000 on just a call that can get absolutely demolished the day after. Look, if we look at the call, the $3,100 call, look at it here. We scroll up. I sold it. I bought one. It would cost me $6,000 just to buy this, and the IV on it is already, it's 80%. It has an 80% implied volatility. That is way too high. That is too high for my liking. First of all, I can't even afford it. Second, I'm not even sure I'd be comfortable buying it with an implied volatility of 80%. That is how people will either blow up their account or make a lot of money on their account, having something like this. But again, if Amazon announces good earnings and shoots up but not enough, you will still lose money. If you buy a call and the company goes up, but it doesn't go up enough because of the implied volatility, you still lose money. The company stocks options sometimes price in a certain movement, and if it doesn't meet that movement, if the stock price doesn't move that amount, you can still lose money. So that wouldn't be the best way to play. So I hope you guys learned something from this. If you guys want me to continue to make more videos about debit spreads or my plays on debit spreads, let me know in the comments. If you guys want more videos about credit spreads and put credit spreads, call credit spreads, whatever. If you want me to make a video about put debit spreads, because I just made a video right now about call debit spreads, let me know in the comments. Any questions you have, I'm here to help. Again, I have a small YouTube channel, so if you have any questions, I'm certainly here to help. But yeah, guys, that's been it. Peace.